Hey everyone, it's Ent, and welcome back to our investment journey. Wow, the market has been a real roller coaster lately, right? It's changing day by day, and I bet a lot of you are looking at your portfolios and just feeling a little nervous. I get it. And that's exactly why, in times like these, we've got to look for companies that are built like a rock. Today, we're going to dig into a really interesting report that makes a bold claim about one company, calling its business model, well, Invincible. The company is Hyundai Marine Solution. Let's get into it.
All right, so let me just throw this out there. What if there was a company that could just sidestep all the usual headaches and risks of its industry and just keep growing? It sounds kind of like a cheat code in a video game, doesn't it? Like an overpowered character? Well, that's exactly the kind of company we're looking at today. So, our story starts with this really bold call from an analyst at Hyundai Securities. And I mean, this wasn't your everyday run-of-the-mill, hey, this stock looks pretty good report. Nope. They put something out there that made everybody in the market stop and go, wait, what?
And here it is, the number that turned heads, a target price of 300,000 won. I mean, wow. To give you some context, their old target was 225,000 won, so they cranked it up by more than 30%, all at once. You just don't make a move like that unless you are absolutely 100% confident.
So yeah, obviously the official rating is a strong buy. But honestly, that's not the interesting part. The real story here is the why. It's not about some temporary fad or a bit of good news. The whole argument, the entire foundation of this bullish call, is built on this company's super unique, super low-risk business model. So what in the world is it? Let's start digging in.
Okay, first things first, let's look at the short-term picture. A big piece of the puzzle is the company's own forecast for the year. And let me tell you, what they're expecting for the second half of the year is, well, it's huge.
Take a look at this. The company's goal for the year is 2.06 trillion won in revenue. So far in the first half, they've brought in 950 billion. You can do the math, right? That means to hit their target, they've got to pull in a massive 1.1 trillion won in just the second half. That's 150 billion won more than they made in the first half. That is some serious growth we're talking about.
Okay, but this is the part where we as smart investors have to put on our detective hats and ask the most important question. Where is that extra 150 billion won actually coming from? Because let's be real, not all revenue is the same. It's where the money comes from that really matters for the bottom line. And this chart here tells the whole story. See, the company basically has two main gigs. One is bunkering, which is just a fancy word for selling fuel to ships, super low profit margins there. But the other one is Ship AM, or aftermarket services, and that is where the really juicy, high profit margin money is. And what's happening? The low-profit fuel business is getting smaller, which means that huge chunk of extra revenue is going to come almost entirely from the high-profit AM business. That is the real engine for growth right there.
All right, now for the main event, the part you've been waiting for. Let's talk about this so-called Invincible business model. What is this company's secret weapon?
So, what exactly is this ship aftermarket or AM business? Think of it this way. It's not about building brand new ships. It's about being the go-to mechanic for all the HD Hyundai ships that are already out there sailing the seas, supplying parts, doing repairs, regular maintenance, you name it. And here's the magic part. Their income isn't tied to the crazy up and down cycle of new ship orders. It's tied to the total number of ships out on the water, which is a number that just keeps steadily ticking up.
So to really nail this down, don't picture a giant factory making new cars. Picture the world's biggest, most important network of auto repair shops. Except, instead of cars, they're servicing these massive, gigantic container ships and oil tankers. As long as those ships are in the water, they're going to need maintenance. It's like a guaranteed, predictable subscription fee from the entire shipping industry.
So, the analyst's Invincible argument really boils down to two key things that make it risk-free. First, it's free from industry risk. You know how shipbuilding goes through these wild boom and bust cycles? Well, this company just cruises right past all that drama. Second, it's free from labor risk. Since they don't actually run huge factories, they don't have to worry about the big labor disputes that can shut down other manufacturing giants. And that point about labor risk is a really big deal right now, especially in Korea. There's something called the Yellow Envelope Law, which basically gives labor unions a lot more power. For a company with huge factories, that's a massive headache and a real financial risk. But for Hyundai Marine Solution, since they're not in that manufacturing game, they are pretty much immune. It's a risk that their competitors have that they just don't.
Okay, I know what you're thinking.
Anthong, this all sounds fantastic, but isn't the stock already super expensive? And look, that is a perfectly fair question. It's probably the biggest question on everyone's mind, and the analyst tackles it head on. So here's the debate. The concern is pretty straightforward. The stock's PE ratio, basically how much you're paying for each dollar of profit, looks high compared to the average company. Totally valid. But the analyst pushes back and says, hold on, you can't measure this company with the same old ruler. Their point is that the sheer predictability and rock-solid stability of its growth puts it in a whole different league.
And this table here really backs that up. Sure, a PE of 30.7 might make you pause, but look at its direct global peers, the other companies doing this same kind of work. They're trading at almost the exact same level. So, yeah, it might look pricey if you compare it to just any old company, but when you put it next to its actual competition, it's right in line. It's priced for the premium business that it is.
So, when you put it all together, the explosive growth, that invincible business model, and the valuation question, what's the final takeaway from the analyst?
Honestly, I think this one quote from the report just says it all perfectly. For a business model with guaranteed continuous profit growth, the expression, the valuation is expensive, doesn't fit. I mean, wow, that's a powerful statement. What they're basically saying is, for a company this reliable, expensive is the wrong word. The right word is premium.
So if you take away just one thing from our chat today, let it be this. The case for this company isn't built on hype. It's built on a fundamental structural advantage that's incredibly hard to replicate. It's a business that just gets bigger and more profitable as more ships sail the ocean. It's basically a subscription service for the world's shipping fleet.
So at the end of the day, it all comes down to a question for you, the investor. The analyst has laid out a case for a business that's like a fortress, totally protected from the chaos of its industry. And the question you have to answer is it worth paying a premium to get inside those walls? As always, that decision is up to you. I really hope breaking this down together has been helpful. And hey, if it was, hitting that subscribe and like button really helps me out a ton. This has been Enthong, and I'll catch you on the next leg of our investment journey.